All right. Thanks everybody again for joining. We're gonna now get started here. Uh, this is the Canary Digital Fund monthly update. Our title for April is Navigating Through the Noise. I'm Stephen McClurg, and my co-PM Josh. I can't even pronounce his last name. I don't know if he can, but we'll get started here. You know, for those of you that know the fund strategy, we've got it up on a slide here. But I want to dig right into what's happening on the macro front, and then Josh will start digging in on what's actually going on in the markets and from a technical and a fundamental basis. So macro, I've been saying this for about 2 months now. Money printing is happening. It's about to happen on a larger scale. Global central banks around the world are both printing money and lowering rates. The US is soon to come as well. And that bodes very well for crypto. We've been we've the market has gone down quite a bit in the last few months since the inauguration. There was a lot of excitement around a new president in the United States that supports crypto. So far, several cabinet members, including the Secretary of Treasury, the Secretary of Commerce, and now the new head of the SEC, are all very pro crypto. And what that means is whether it's trade, whether it's coordination with the Treasury Department, or even potentially the Fed in the future, but certainly around the SEC, we are going to have more regulatory clarity. A roadmap is currently being built that is headed up by Hester Pierce, that will define exactly where tokens fall. Are they a security? Are they not a security? Are they a meme? Are they a collectible like an NFT? Are they a currency? Are they a protocol gas? And when all of these functions are finally defined, we'll be able to move forward with the next slew of ETFs. As some of you might know, Canary's actually been pretty active on the next level of ETFs after Bitcoin and Ethereum, and we are also excited to see what the SEC is going to say. But outside of regulatory clarity, outside of a general positive note among Trump's cabinet, and even among the majority of the Senate now and the majority of the House, money printing is always good. One of the things that has been really upsetting markets lately is tariff talk. And regardless of how you feel about whether or not the US should have tariffs or shouldn't, I'm actually in the camp of we do need to have reciprocal tariffs with countries that have either tariffs or barriers against the US. And they need to be clear. They need to be defined. It's not quite so clear right now, and we are starting to get a little bit more clarity. But regardless of what you think, tariffs have created a bit of short-term corrections in the market, but tariffs don't really affect crypto. They affect equities, and this is one of the reasons why we're seeing a decoupling of risk assets. There's been an effect on bonds. There's been a negative effect on equities. Crypto in the beginning had a negative effect because of the unclarity. But now that there is more clarity in the markets, and tariffs don't affect crypto as much as they would equities. The reason why they obviously affect equities is because of supply chain potential cost, buying products to make things and then selling those products in other countries will definitely have a drag on equities. And we're going to continue to see that through the rest of the year, but they don't have the same drag on crypto. As I said earlier, when the money printing machine comes on, and this has been a long time coming, China, Germany, other countries have been in a technical recession for years now, even though it's slight. but those issues aren't going away. Same thing in the UK. There are drags on GDP in the UK that have been there for the last couple of years, as well as high inflation that occurred at the same time. A lot of the inflation issues have been slowly resolving itself as people can afford to buy things, so the cost of things go down. Uh, but uh, uh, but with inflation continuing to come down in the U.S., with unemployment, I believe there's going to be a big uptick in unemployment. I do expect to see many companies lay off, as well as the government continue with layoffs. We need to get back to a more natural unemployment rate, which the natural rate is actually about 5 to 5.5%, and we're below that still at the moment, but the trend is upward. I do believe that by the end of the year, we could see unemployment somewhere between 5 and 6%. So that is a natural level, but the Fed will likely have to step in to lower rates to stop the trend upward in unemployment and to backstop inflation. There's also a big push from the Trump administration to actually uh, have the 10-year go lower. Now, the Fed doesn't have a lot of control over the 10-year through rate policy, but it does through purchase policy, uh, which would be adding longer term bonds to its balance sheet. Uh, Obviously, one of the reasons why Trump is so big on the 10-year coming down is because he is a real estate person, and most real estate rates are tied to the 10-year, whether it's 30-year fixed or other commercial rates. So it's going to be a big push there. We're already seeing uh, cost of homes and commercial properties coming down in a lot of areas. There's still some areas that are holding strong, but most areas are coming down in multifamily, as well as single family, as well as offices. And as those prices come down, lower rates is really what's going to create a floor for them. At the rate at mortgage rates where they are today, which is currently about 6 to 7%, it's just a little too high than what the market is used to. So hence the push from banks, from lenders, and of course from the president on wanting to push rates down. So we do expect again easy monetary policy in the U.S. Coming imminently. I'm actually a believer that we could see a rate cut in May, if not some type of easing that comes in May, and that could be either in the form of again a rate cut or the slowing down of unwinding of the Fed's balance sheet, which has been at about you know uh, a pretty good clip over the last few months. So it's even possible that we see some more buying activity. But that's where we're at. It's I was pounding the table on easy money a couple of weeks ago, even more so a week ago, and sure enough, crypto has caught up. We've seen a massive rally in crypto assets in the last few days, and it really is two factors. The fact that number one, there's a lot more clarity and subtlety in tariffs than there was a month ago, and also an understanding that sure enough, the money printer will start again at the Fed.
I thought I'd throw these data points for next week on here because the markets have been extremely reactionary to anything talking about consumer health or spending. I think the big one on here is obviously GDP, which has been up in the air as far as what it's actually going to be. But we also have had a ton of employment data next week. We have Mag 7 earnings next week. We've got, I threw McDonald's in there, Visa, Coca-Cola. Again, uh, there's going to be discussions about purchasing strength and consumer health in that in those earnings calls, right?
Yep. Yep. That's
And I don't
absolutely
know
right.
if you had any additional thoughts on GDP for us, Stephen.
Yeah, look, I still believe that GDP is going to end up being positive for the year in the U.S., but it's not, but it's going to be it's going to be lower than lower than what it has been globally. There's already adjustments made on on GDP coming down. So global GDP will likely come in at about somewhere between 1.5% and 2%. In the US, we'll probably end the year somewhere around 1 to 2% as well.
Like you said with rates, we've had an internal debate. Stephen thinks we may see a cut next meeting, which is May 7th. Market's not quite there, but more importantly, as Stephen has said, the market is pricing in 4 cuts for the year still.
There's
And
some
that,
analysts out there that are even predicting as much as 150 basis points worth of cuts, which I think is actually it's possible, but not very probable. But let me talk a little bit about cuts here and how the Fed works because most of the country believes that the Fed is a federal agency, and it's actually not. Sure, the Fed chair is appointed by the president, confirmed by the Senate, but at the end of the day, the president usually appoints the person that the CEOs of the largest banks tell him to appoint. And the Fed is not run by the government. It's not funded by the government, although they take government funding. It's actually owned and ran by the largest banks, the Fed members. So the most powerful bank is JP Morgan, which is run by Jamie Dimon, which makes Jamie Dimon probably the most powerful person when it comes to Fed policy. Jamie Dimon came out against Trump on some of the tariffs. So first of all, um, I believe that Trump's number one priority is getting rates down. Tariffs are secondary. He's using tariffs not only to negotiate with other countries to remove barriers and to lower their tariffs to help with U.S. manufacturing and exports, but also is not afraid to use tariffs to negotiate anything. And Trump's not just going to back off because Jamie Dimon tells him to. He's going to back off and implement a 90-day reprieve on tariffs because they negotiated a deal. And Trump telling Powell to lower rates isn't going to cause rates to be lowered, but Jamie Dimon telling Powell to lower rates will cause rates to be lowered as long as the other bank CEOs are in line. Also, keep in mind that Ackman is an advisor to the New York Fed. So between Ackman and Dimon, if a deal was cut to smooth things out with pushing tariffs off, it was likely to get Powell to lower rates. So there could be a surprise rate cut coming either in May or again, like I said, in the form of uh, other types of easing, such as purchase of assets or slower unwinding of assets. But those activities would cause the 10-year to come down. And so there was likely a deal struck. And if you start hearing rhetoric around or before May 7th that, oh, wow, it looks like uh, unemployment is trending higher, or it looks like we have inflation under control, pat ourselves on the back, great job. Now it might be time to actually, put in a rate cut. So it is very possible that we see that type of rhetoric in the days coming up to May 7th, and an actual rate cut happening then. I would actually put the probability of a May rate cut at about 70%.
Stephen also was talking about inflation coming down, and it kind of still baffles my mind that the amount of real-time data we're getting that says we're sub 2% has been there for a couple months now. I know a lot of people are concerned about the forward inflation numbers with tariff uncertainty, but the data we're seeing so far, I know the tariffs aren't like even with us yet in the room, but they we're not seeing the tariff effect yet on the inflation data. And the trueflation line there in the gold has been, like I said, sub 2% for over 3 months now. It's hovering at like 1.3% year over year. Obviously, that's not going to help the aggregate inflation that we've had since COVID. But the year over year numbers have certainly gotten crushed pretty significantly. And as a few people have brought up, why are we cutting 50 basis points before an election when the markets were at all-time highs and now the markets are down 20% and inflation is where it is and we're not cutting. So that is a bit of an interesting dilemma from Powell's perspective. One other thing to keep in mind with employment this week, like Steven said, if we start to see unemployment spike on Friday for whatever reason, maybe that's enough to get the Fed moving on the rate cut front. And we also have a deeply uninverted yield curve now. It was flirting with being inverted again for a little while there, but at this point, it's I think safe to call it that it is deeply uninverting, and the 10-2 curve, the 10-year 3-month curve, is kind of back and forth, oscillating a little bit. But it's just interesting that we typically see both together. They're not exactly uh, at the same time necessarily, but you typically see an inversion of the curve with a rise in unemployment. So as far as expectations are concerned, I don't think it's too much to think that we're going to see unemployment rise at some point, most likely, certainly. And we've been talking about dollar weakness since we started doing these webinars last year, just because coming into Trump's term, Trump said, along with his team, that they want the dollar down. Now they're saying they want to make sure we're still a global reserve currency. Okay, fine, whatever. But looking at the index, the XY index, it has mirrored what happened in 2017. And this is important for crypto because this feeds into the global liquidity equation. This feeds into where people want their assets. Do they want them in US denominated equities, or do they want them in something else? And it helps push the pendulum in crypto's favor and gives us that tailwind with the DXY weakening. And just looking at the comparison between Trump's two terms, we're kind of mirroring what we saw in 2017. I don't necessarily remember the rhetoric exactly in 2017 at that point in time, but I know there was a lot of hemming and hawing about tariffs in 2017, and then they finally got implemented in 2018. But crypto, for those of us who remember, took off significantly in 2017 into 2018. So we continue to expect to see the USD weakness, and it should be helpful for crypto. It should provide a tailwind. Here's the liquidity index globally in the purple there. The Bitcoin and gold lines are sort of on a different axis, but I just added those to show you that there's certainly an echo here. Gold is closest to the global liquidity index as far as the oscillations and the movements. And okay, we saw global liquidity rise. We see gold obviously hitting all-time highs. It has pulled back a little bit today. But this is really good for Bitcoin because historically, Bitcoin is 50 to 100 days behind global liquidity and gold. So once gold settles down, slows down a little bit, it's now our turn. And we see this pattern. We have seen this pattern for many, many years. So it's not out of the question to see Bitcoin strength picking up again. Many people predicted this for months, for weeks, as we saw the global liquidity index sort of dip and then pick back up, and now it's at all-time highs. And if the expectation was liquidity going in the opposite direction, it would be much easier to be bearish, but that's not the case. And you're already seeing the gold effect. You're already seeing what's going on there. So we are very bullish in the rest of the quarter for BTC for that reason. BTC also, if we look at all the average daily return from 2014 to present, you get this seasonality picture. And Q2 generally is bullish. Q4 is the most bullish. And into Q2, even on a seasonal adjustment, we tend to try to bottom into Q2 and then do decently well throughout Q2. So we've deviated a lot from that coming into this quarter and have started to turn the boat around a little bit based on seasonality. And none of this individually is going to, build the puzzle completely here, but collectively, when we're looking at rates and liquidity and technicals and fundamentals and everything together, that certainly helps our decision-making process. And looking at the remainder of the quarter, it's pretty beneficial. Seasonality, again, tailwind or headwind, tailwind. Okay, great data point. We'll take it. Q3, on the other hand, the opposite of that, where September is generally awful, and we tend to bottom sometime in October, going into a very bullish Q4, which we saw just last year. And I think everybody can remember what happened last year. There's always a reason, whether it's the election or some other thing going on. There's always something. Something else people always ask is, okay, are we still in a cycle here? Where are we at in the cycle? Which year is this most like? All the years are different in their own little way. I think the biggest takeaway from this is from the cycle low, we are currently almost 900 days in. So we're probably closer to the end than the beginning at this point. But if we continue to follow the 2017 path, just as far as duration, that gives us a potentially another, into Q4, let's just say, right? Another 200 days or so, where we still have some juice in the tank just based on this when we're comparing to 2017. Now it's totally possible that we just continue to have shallower rallies and shallower dips, and we just continue till any period of time. But looking at the typical Bitcoin cycle, we are in the last year of expected, I'll call it, bullish returns, with 2026 potentially being the negative year in the cycle. So it's certainly something we're mindful of, but we're not, stuck to that. If technicals and fundamentals and liquidity and rates and everything else look bullish in going into 2026, then we'll continue the path we're currently taking with the fund. But otherwise, the mental model is 2026 is going to be more bearish than the previous 3 years, at least. If we look at ETF flows for Bitcoin and ETH basically can't get off the mat flows wise. I think it's it's got a few problems. It's difficult to explain to people what it is and why they need it and why not just BTC, at least from an institutional perspective. It doesn't have staking yet, those ETFs, so they're strictly worse than staking vehicles. And the Bitcoin story is clear and obvious relative to ETH, right? So if we look at the flows, up until this week, flows have been down or flat, basically, even for BTC. Yesterday, we had nearly a billion in inflows. Great. Can we maintain that? Can we continue that? We don't need to see a billion every day, but some positive flows here go a long way, especially when we're trying to reclaim the 90s into the 100K region. It's going to take some institutional level flows to push us there and keep us there. So it's a good first sign that not only, this wasn't just a leveraged rally. We saw some spot buying as well, some pretty significant spot buying. So that's what we want to see on the ETF front. And as far as the cost basis for the ETFs, currently it's around 71K. And if we look at, we don't have a lot of data, obviously, but if we look at what we've seen from the deviation of basically what we're looking at here is unrealized profit relative to the cost basis. You can see how we deviated pretty far away from that at the end of Q4, and we came all the way back down. And if we can maintain anything above 71, maybe with a smoother path relative to what we saw at the end of Q4, then we have a better chance of holding those levels and maintaining those levels. When we have that amount of unrealized profit sitting in the ecosystem, people are more likely than not to sell instead of buy, right? I think that's just natural human behavior. So this is one way of looking at that. And right here, right now, it's elevated, but it's much less elevated than it was in 2024, obviously. That cost basis has come up quite a bit since the ETFs launched. So it's going to be something we are going to continue to monitor. Along with the cycle question is, okay, how much of a drawdown is theoretically recoverable? So if we look at the drawdowns in the red there, the red fill at the top, since 2014, you can see in a bear market, we typically draw down anywhere between 70 and 80%. In a bull market, we typically stop around 30%. in the drawdown. So we hit that roughly the other day, and we've since started to recover. We're in like the 15 to 20% zone for drawdown. But if you're not crypto native, you're probably not used to drawdowns this deep recovering. But the truth is, historically, we're on par for what we've seen, which is 20 to 30% drawdowns being recoverable. I also added the 5200 Death Cross, Golden Cross on here. Now, these are obviously late from a trend perspective, but you can't have a bear market without a Death Cross, and you can't have a bull market without a Golden Cross. So we're currently in this transition phase where we just had the Death Cross a few days ago. And again, looking at this historically, okay, how long does this take to recover? It's usually 40 to 80 days. That brings us to at least the remainder of the time here. Again, within Q2, it's within the realm of possibility as far as trend continuation. I think early Q3 bullishness is possible, but September is always typically very, very bad for returns for whatever reason seasonally. So this drawdown recovery looks good. It is possible to continue from here, and there's no like warning signs that the cycle's over just yet. That's obviously easier to say now that we're up 10% in 3 days, but that would have been the message regardless of the outcome here on price. And one other thing to mention is the relative outperformance we've seen from BTC compared to the benchmarks, the SPY, Qs, gold, TLT. And obviously against gold, we've pulled back quite a bit. But if we look at since the spot ETF inception date, we are up considerably, even against gold still. So the question is, are we decoupling? Are we beta to NASDAQ? It's probably difficult to see, but we're approaching or breaking all-time highs here on the relative pairs of IBIT against the SPY. So whatever's happening helps us in the conversation when you're given this menu of assets. Okay, what does this thing do? How does it perform? Is it correlated or not? Once we start to gain against the SPY, you've got fund managers and allocators thinking, okay, maybe this thing is worth getting into, right? From a non-crypto native perspective. It's hard to continue to ignore when we're performing like we are. So that's certainly very helpful for flows on the institutional side. And then against TLT, it's kind of a joke. I mean, it's just rough because the long bond continues to underperform pretty significantly against BTC. Looking at a multi-year zoomed out channel here for BTC, we're still in the channel. Again, if we're trying to prognosticate where could this go throughout the rest of the year, 125 to 150 is not in the ballpark of impossibility. And if we just look at what happened the last time we were deviating from this channel, 130 to 150 is certainly reasonable as far as an expectation for the year. I don't know about Q2, but I think for the year that's a reasonable expectation. Just to compare this to MSTR, which is typically behaving 2x BTC, similar story where this could have quite the run here the rest of the year, potentially if BTC remains bullish. Something to pay attention to for MSTR is the premium to NAV, which is still at 1.8. But there's some idiosyncratic stuff to think about when you're playing around with MSTR. But there's still a potential here for a 2x even on MSTR. So I think there's a lot of options and opportunities in the investable universe, as they say. And on our favorite trend metric, the cloud, we have at this point reclaimed bearish territory, neutral territory, I think ranging from 87 to 94 per week is reasonable. I think it's unlikely that we're going to continue pushing 100K from here, but the 94 level today to me looks a lot better than it did in Q4, where we continued to knock on the support door of 94, and then it eventually opened and we fell through. Now it makes a lot more sense here to establish a new level, normalize this level again on the way up, and then continue throughout Q2. So there's certainly some more things to look for trend technicals to flip even more bullish. But we obviously, it's hard to be bearish when you have 10% in a couple days. Altcoins, broadly, a different story. This is a altcoin index relative to Bitcoin, and it's down, 2, 3, 4 years in a row consistently. Will this bottom? Where will this bottom? What does Bitcoin dominance look like? We're constructive on some alts here, like Solana, for example, that have had a history of success, and the market adopts them as the de facto altcoin to trade. But for us anyway, the portfolio is still the majority in BTC for this reason, because collectively alts have done very poorly in general over the past couple of years, and the technicals still look quite bearish. And if we look under the hood for ETH, as far as network activity, it's still flat to down. If we look at active addresses there on the left, not something you want to see in a global computing network. And then if we think about the ETH supply, there is a burning mechanism relative to the fee component, and that has basically gone to zero. So that just means ETH is effectively similar to BTC in the emissions front when it comes to the daily coin inflation, is one way to think about it as well. There was a narrative that ETH was going to burn a ton of supply, and it was going to see all this usage, and that hasn't really been the reality. We have not seen that burning mechanism consistently removing supply. Sol's similar in that if you look at new addresses versus active, new addresses have fallen off quite a bit since Q4, still higher than they were in mid Q4, but obviously activity on Sol is down quite a bit, and total fees on Sol, just another way of measuring activity, has come way down as well. So, if you're pitting both of them head to head, Sol still comes out better than ETH, but we're still seeing a huge decline in on-chain activity for both. And then just two quick interesting things to think about here going forward. In a world, again, where you can trade everything and anybody has access to everything, Sol and MSTR are very similar in the way they trade. At least historically, they have been similar. Again, 2x Bitcoin analogs, roughly. Sol and MSTR were super correlated in 2024 up until about a month before the election. And then since that time, this correlation has really widened out quite a bit. So from a trading perspective, it's interesting to think, okay, is this going to continue? Is MSTR's outperformance going to continue? Is Sol going to recouple with MSTR? Just interesting things to think about for the rest of the year, because that's a huge opportunity for Sol potentially on a relative basis, and even relative to BTC, to catch up. And that's where you may see some outperformance to BTC. And then lastly here, I know Coinbase is a popular trade for a lot of people, and Coinbase has held a super tight correlation with Total 2, which is again the altcoin index. So if you're trading Coinbase, you're basically trading an altcoin index. So if you're not bullish on alts, then it doesn't make too much sense to be bullish Coinbase. But this correlation has held almost since Coinbase's IPO. So it's going to be interesting to see as we get more exchanges coming online with crypto like Schwab, as we get more exchanges like Kraken adding equities. How is this going to end up in a couple months in the end of the year? Is Coinbase, are the best days of Coinbase behind it from a trading perspective just because of market share, or is it going to continue this correlation? Again, something interesting to think about. Stephen, do you have any last final words here?
Yeah, my final words, and wrapping it into a question that we received. So if you look at global monetary supply, and I look at M2 when I'm looking at that, then Bitcoin should go to about 120, about 125. That's just me looking at a macro basis. If you look at expected global monetary supply growth or global M2 by the end of the year, then Bitcoin could go as high as 140, 150. So there was a question about, is there any juice left in Bitcoin? Long term, there's a lot of juice left in Bitcoin. Short term, we are approaching the end of the cycle. This year probably is the end of the cycle. We've got probably another 30 to 50%. Well, I wouldn't say 30 to 50. Probably 30 to 40% uh, in growth in the price of Bitcoin now, probably higher in some other alts. But if you follow our strategy and follow the way that we do things, we typically are in and out of risk. So we'll follow the trend up, and then we'll start trading out of crypto and move more into fixed income. We still trade crypto in a bear market because there's still money to be made in a bear market, but a lot of our long-term holdings that we're trading around will be moving over to bonds either at the end of this year or into 2026. So yes, there is more opportunity this year. There is more opportunity long term. We're taking advantage of that, and we're mitigating a lot of that risk for our clients.
Excellent.
And on that note, just want to thank you all for attending. If you have any questions and you want to get more information about the fund, please contact Jack Burke, whose information is here. Or you can also contact Amber, who's also quietly on our call with us, who's our head of investor relations. But I want to thank you all and have a great day.